If you glanced at your trading screens today, you basically just saw this spectacular sea of green.
Oh, yeah, everywhere.
Right, like you saw the S&P 500 jump, the Nasdaq surge, and the financial headlines were essentially out there declaring that the bears had been entirely defeated.
Yeah, on paper, it looks like a phenomenal risk-on session.
Exactly. But if you look strictly at the mechanics underneath that rally, the actual order flow,
Huh.
the sheer lack of volume, you realize pretty quickly that today's rights action is, well, it's kind of an illusion. It is Tuesday, July 21st, 2026, and today for our deep dive, we are looking at the mechanics of what I'm calling a ghost town rally.
It really is the ultimate paradox of the tape today, isn't it? Because the structural foundation of how those numbers were actually achieved, it's highly fractured.
Yeah, it really is. Okay, let's unpack this. Let's just lay out the scoreboard first, just to capture the sheer scale of the headline numbers. Because the bulls absolutely snapped that bruising three-day slide we've been having. We had the S&P 500 up 0.9% to close at 7,509.20.
Right, pushed right over that 7,500 mark.
Exactly. And the Nasdaq Composite, that surged 1.3% to land at 25,837.21. We had the Dow jumping 0.7% to 52,224.64. And then the small cap Russell 2000 actually outpaced all of them, just popping 1.5%.
Which sounds incredibly bullish, right? But if you drill into the sector data, technology, the XLK ETF, that surged 1.8%. But you have to realize that wasn't driven by some sudden organic wave of long-term conviction.
Right, it was mechanical.
Exactly. It was heavily mechanical. A significant portion of that was just this massive wave of short covering in the semiconductor space.
So the people betting against it last week.
Right. The traders who were aggressively betting against the chips last week, they were suddenly forced to buy them back just to cover their positions. And that creates this mechanical, artificial bid under the market. So this wasn't a coordinated stampede of eager buyers. It was a profoundly split-brain session.
Which, I mean, that brings us to the glaring issue underneath the hood today. Because before anyone celebrates those headline gains, we have to look at the volume, the literal number of shares that actually changed hands.
Yeah, the volume tells the real story here.
It does. The overall broad market activity was entirely muted today. We sat well below the year-to-date daily average of 19.48 billion shares. So you have all these prices surging, but the actual heavyweights, the massive pension funds, the institutional mutual funds, they're clearly just sitting on their hands.
Because volume is, it's the undeniable lie detector of the stock market. Price tells you what happened, but volume dictates the actual conviction behind it.
Right.
When prices surge on low volume, the market is effectively thin. Think of it like, imagine a massive swimming pool, right? But it only has 2 feet of water in it.
Okay, I like that analogy.
Right. So if you jump in, you're going to make this massive splash, and the water level will temporarily surge up the sides. That's a low liquidity market. It really doesn't take a lot of actual institutional dollars to push a stock up 10% because the order book is just hollow.
There just aren't enough active sellers resting at those price levels to absorb the demand. And the specific data points on this are just wild today. You look at 3M, ticker MMM, the stock skyrocketed 10.2% today to $175.32 on a massive earnings beat. And I mean, a 10% move on a mature industrial company like 3M, that usually requires massive institutional accumulation.
Oh, absolutely. Heavy buying.
Right. But the volume was 42% below its average daily volume.
Yeah, that's a huge red flag.
And it wasn't just them. Lightwave Logic, ticker LWLG, jumped 9.5%, but it did it on 86% less volume. And the vacuum, it totally works in reverse too. Samsara, ticker IoT, they fell 4.7% today on 78% less volume.
Wow.
Yeah. It's like walking into this supposedly sold-out stadium concert. The music is blasting, but half the seats are totally empty.
Yeah, it's a low liquidity relief rally. That's exactly what it is. That, to be fair to the bulls here, the surface level market breadth did look decent today.
True, yeah.
We saw an advance to decline ratio of about 2.7, which means almost 3 stocks went up for every one that went down. And 8 of the 11 S&P sectors finished in the green. But if you look at the medium-term health indicator, it's flashing a really serious red flag.
The 50-day moving average, right?
Exactly. Only 61% of S&P 500 stocks are currently trading above their 50-day moving average. And that is actually down from 70% just recently.
So even as the primary index pushes back up toward these massive highs, the actual percentage of individual stocks participating in that medium-term uptrend is shrinking.
Yeah, the index is basically being propped up by a smaller and smaller handful of giant companies.
Right.
It's a market built on fewer pillars. And without institutional volume getting back above that 30-day average, the foundation is just incredibly brittle. As the saying goes on the institutional trading desks, this is a market to rent, not to buy.
You can trade the momentum, but you do not want to marry the position. So if broad conviction was that low and the real money was just sidelined today, we have to talk about who exactly was driving the action. Because the tug of war between the mechanical algorithms and the human discretionary traders today, it was fascinating.
Yeah, that is where the whole split brain dynamic really reveals itself. You basically have two totally different playbooks running simultaneously. They're looking at the exact same market, and they're executing complete opposite strategies.
The market on close print, the MOC, is the perfect example of this.
Absolutely.
For those tracking it, this is the final tally of massive institutional orders that get executed right at the end of the day. And today, that mechanical MOC print showed a massive sell imbalance.
Yeah.
The algorithmic trading models were just systematically fading the rally. They were selling into the green to reduce their exposure. But at the exact same time, the institutional high-touch desks, the actual human discretionary managers, they were doing the opposite. They were manually buying the micro dips, specifically in technology, media, and telecom, the TMP sector.
Because the algorithms are programmed to ruthlessly flatten exposure, right? They see a low-volume price spike, and they just systematically sell into it to reduce risk ahead of major macroeconomic catalysts later in the week.
Yeah, they don't have emotions. They just sell.
Exactly. But the fast money players, the discretionary human managers, they're looking at how violently semiconductors were beaten down last week, and they're just selectively nibbling.
Yeah.
They aren't panic selling. They are quietly model rebuilding.
And that dynamic created just staggering whiplash on individual stocks today. I mean, look, NVIDIA, ticker NVDA, it opened strong at $205.87. It surged to an intraday high of $207.74, and then it just completely ran out of oxygen.
Yeah, totally faded.
It faded so aggressively to close almost flat at $203.28. That is up a measly 0.23% for the day. And the reason that is so counterintuitive is that NVIDIA just revealed a massive 9.3% passive stake in Nebius Group, ticker NBIS.
Which is a huge deal.
Right. A mega-cap tech giant taking a nearly 10% stake in a cloud infrastructure player is a massive catalyst. It should have been off to the races, but the stock just bled out.
It is textbook buy the rumor, sell the news behavior, honestly, and it's compounded by just this sheer terror of what tomorrow brings. Market sentiment is incredibly fragile right now.
So they just use the pop to get out.
Exactly. Traders see the initial pop on that Nebius news, and they immediately use that incoming liquidity to sell and de-risk their portfolios ahead of the upcoming mega-cap earnings. They are literally using the good news as an exit door.
Wow. And then you have General Motors, GM, which was the exact inverse today. Like, the stock slid 1% on the pre-market because the company announced a massive $2.3 billion charge for an EV strategic realignment.
Right, which sounds terrible.
Yeah, a multi-billion-dollar charge is objectively bad news. But then the opening bell rings, and buyers completely flood the stock, and they drive it to close deep in the green.
Yeah, it ripped.
And the reason is that underneath the bad headline, GM posted a blowout adjusted EPS earnings per share of $3.57, which utterly crushed the $3.20 expectation. But more importantly, they raised their full-year EBIT guidance. Their earnings before interest and taxes, their core operating profitability, they raised that to between $14 billion and $16 billion.
And that right there, that highlights how institutional markets value companies in real time.
How so?
Well, with GM, the algorithms and the smart money, they looked at the $2.3 billion EV charge and categorized it strictly as a rearview mirror problem.
Right, a one-time thing.
Exactly, a one-time structural write-off. But the raised forward guidance, that is future cash flow. And the market will consistently buy future cash flow and forgive past sins.
But they show absolute zero mercy if you threaten that future cash flow.
Oh, none. None at all.
Look at Danaher, ticker DHR. This is a massive defense of heavyweight. They actually beat their Q2 earnings expectations today with the $1.94 in adjusted EPS. But management warned about slowing bioprocessing orders, and they slashed their Q3 core revenue growth guidance down to just 2 to 3%.
Yeah, that was brutal.
The punishment was immediate. It gapped down 15% in the pre-market to $170.75, and ultimately closed down 12.5% at $175.99.
Because the market is just utterly ruthless right now. A beat on the previous quarter means absolutely nothing to these guys. If you tell the street your next quarter is going to stagnate.
Right.
Valuation multiples are just way too high to support decelerating growth in this environment.
And then, just to keep everyone guessing, we had Micron, ticker MU, the absolute trend breaker of the sell.
Yeah, that chart was wild.
Yeah, this stock had plunged 25% earlier in July, But today, it surged 12%, a massive high-conviction intraday reversal.
Hmm.
And it was driven by Bank of America slapping a $1,550 price target on it, and the chairman of SK Hynix basically stating publicly that customer demand for AI memory is going to outpace supply by 60% to 100% next year.
Which is exactly what the bulls needed to hear. The structural shortage story for AI memory chips is still very much intact, right? And when a stock like Micron gets heavily discounted like it did, fast money players will violently step in to find the floor.
So what does this all mean? Like, it feels like we are watching two completely different markets operating at the exact same time. The fast money discretionary traders are desperately trying to find the floor on beaten down names, which is why Micron popped. But the broader mechanical systems are flattening out and fading the rallies because they are just terrified of what happens tomorrow.
Yeah, it's what we call the great volatility split. And it's one of the most important dynamics happening right now. And honestly, the average retail trader is completely missing it.
Okay, let's get into the mechanics of that, because the divergence in the volatility index, the VIX, tells the real story of today's market.
It absolutely does.
On the surface, the VIX dropped today. It cooled off to a very comfortable 17.25 to 17.80 range. The VIX 1D, which specifically measures one-day implied volatility, absolutely collapsed, dropped 19.53% down to 13.43.
Right, massive drop.
So the immediate reading is that the market thinks today is perfectly safe. But the VIX IND, which measures volatility over the next 9 days, that actually rose 5.52% to 17.78.
Because the options market is, at its core, a highly sophisticated insurance market.
Yeah.
When the VIX 1D collapses, it just means nobody feels the need to buy fire insurance for their house today. The weather is clear.
Right.
But when the VIX 9D spikes at the exact same time, it means institutional players are taking all that capital and aggressively buying fire insurance for next week.
Because next week is a complete minefield of catalysts.
Precisely. I mean, we have Alphabet and Tesla reporting earnings tomorrow after the bell. We have Intel coming up. We have critical PCE data, the Personal Consumption Expenditures Index, which, is the Federal Reserve's absolute preferred yardstick for measuring inflation. And looming over all of that is the July 29th FOMC decision on interest rates. The market effectively pulled all of its anxiety out of Tuesday and just loaded it directly into Wednesday and beyond.
Here's where it gets really interesting, though. Because that anxiety isn't just about whether a tech company beats its earnings estimates by 2 cents. This is where the complacency of equity traders today is just astonishing.
Yeah, the macro picture.
Exactly. The S&P gained nearly 1% today on low volume. But look at the macroeconomic and geopolitical reality happening in the background. Brent crude oil is hovering at a steep $91.2 to $92 a barrel right now. WTI crude is near $84.52.
Which is a direct mechanical driver of global inflation.
Right. And oil is sitting at $92 because the U.S. and Iran are now in their 10th consecutive day of direct military strikes. This is actively disrupting tanker traffic in the Strait of Hormuz.
Yeah, it's a massive disruption.
And purely from a market mechanics perspective, we are talking about a major geopolitical conflict heavily impacting global energy supplies. And on top of that, the 10-year Treasury yield, the foundation of all corporate borrowing costs, is sitting incredibly high at 4.59%.
Right. The bond market isn't ignoring it.
Exactly. So you have a major maritime conflict, 92 oil, and a 4.59% 10-year yield. And equity traders completely ignored all of that today just to buy semiconductor microdips.
What's fascinating here is how that creates such a dangerous setup. When a market rally relies on fewer and fewer stocks, going back to that shrinking 61% breadth metric we talked about, and it actively ignores massive macroeconomic tail risks like surging oil and elevated bond yields, it becomes incredibly brittle.
It's just massive complacency.
It is a state of severe market complacency because the mechanics are all interconnected. If oil stays at $92, inflation metrics like the upcoming PCE data simply will not cool down. If inflation doesn't cool down, the Federal Reserve is mathematically forced to stay higher for longer at that upcoming July 29th FOMC meeting. And if borrowing rates stay high, a stock market trading at these extreme historic valuations will eventually face a very harsh reality check.
So, if the broader market is trapped in this algorithmic tug-of-war and facing all these macro headwinds, how do you actually trade individual names tomorrow without getting chewed up?
You have to be incredibly precise.
Let's talk about the exact setup for the opening bell, because the critical battleground for the S&P 500 revolves entirely around the 7,500 SPX gamma wall. Now, the bulls managed to close just above it today at 7,509.20. And my understanding of this gamma wall is that market makers are basically trapped around that 7,500 level.
Yep, they're pinned there.
Right. They
Yeah.
sold a massive amount of options contracts there, so they have to delta hedge by buying the underlying index if we go up, which essentially creates a mechanical squeeze that pushes the price even higher. Is that what drives us to that Mac pain zone?
That is exactly the mechanism. You have to think of 7,500 on the S&P 500 as this absolute gravity, well, for the options market right now. It is where a massive amount of positive dealer gamma is concentrated.
Right.
When a market maker or a dealer sells you an option, they take on risk, obviously. So to stay delta neutral, meaning they don't lose money whether the market goes up or down, they have to constantly buy and sell the underlying futures to hedge their position.
Makes sense.
So if the market opens tomorrow and holds clean above that 7,500 line, there is this massive air pocket of open interest above it. Dealers will be mechanically forced to buy to maintain their hedge, which triggers that short covering squeeze, and that rapidly pushes the index up to the max pain zone of 7,520 to 7,525.
But if we slip back below 7,500, that entire mechanism just works in reverse.
And it gets ugly fast. If we break below 7,500, dealers will be forced to aggressively sell futures to stay delta neutral. That mechanical selling pressure triggers a rapid slide down to the 7,480 to 7,489 zone.
And if that breaks,
If that support level breaks, the ultimate safety net, like the hard floor, is way down at 7,435. Based on the current options positioning, there is only a 60% probability of continuation for this rally tomorrow. If we don't see immediate high-volume follow-through right at the open, you should expect a very choppy, range-bound mean reversion day, trading strictly between 7,435 and 7,500.
okay, so that gives us the macro index mechanics. But zooming in on the micro, we have two very specific day two plays to watch on individual stocks for tomorrow.
Yeah, these are key setups.
First up is Nabius Group, ticker NBIS. This is a pure momentum continuation play based on that NVIDIA 13G filing we discussed earlier. NVIDIA formalizing a 9.3% passive stake is just a massive validation of Nabius's AI cloud infrastructure. Plus, they just announced a fresh $1 billion compute supply deal with Reflection AI.
Right, the catalyst is there. And the institutional action plan for Nebius is highly precise. The stock surged double digits today, and dip buyers aggressively defended the low 200s every single time it dropped.
So what's the trigger for tomorrow?
Tomorrow, the technical trigger is an opening drive above Tuesday's high. You are specifically looking for a break above the $212 to $250 resistance level. If it breaks that level with actual volume confirmation that's crucial, the target is a squeeze toward $225 and beyond.
But you have to manage the downside.
Absolutely.
Yeah.
Because this is a high beta, highly volatile name, the mechanics demand strict risk management. You place a hard stop loss just below the $195 support shelf to protect against algorithmic shakeouts.
Okay, play number two is Capital One Financial, ticker COF. This is a classic earnings breakout play. They dropped their earnings report right after the closing bell today, and it was just a monster double beat.
It was huge.
The adjusted Q2 EPS came in at $5.81. The Wall Street estimate was only $4.77, so they blew that out of the water. Revenue hit $15.85 billion, beating the $15.77 billion estimate. And on top of that, their credit provisions, the money they set aside for bad loans that actually decreased by $1.1 billion, and they confirmed their integration with Discover is entirely on track.
It's a textbook bullish report. Capital One closed the regular session at $210.10. The setup for tomorrow morning is watching for a gap and go right at the open.
So buying the momentum immediately.
Only if the volume is there. Because the earnings were so strong, you need to see heavy institutional volume actively accepting the price above that $210 level. If that volume confirmation is present, the thesis is to go long, targeting a multi-day momentum expansion as analysts naturally upgrade their price target.
And if it fades,
If the stock fails to hold its ground at the open and breaks below 206 stocks, the breakout thesis is completely invalidated and you just abandon the trade. Do not hold it, hoping for a bounce.
it constantly comes back to the core mechanics, doesn't it? The gamma levels, the volume confirmation, the algorithmic selling versus human buying. It really makes you rethink what is actually happening when you click buy on your brokerage app.
It really does. I mean, when you watch institutional algorithms systematically sell into a rally to reduce risk, at the exact same millisecond that human discretionary traders are aggressively buying the micro dips on tech stocks, it leaves you with a rather profound puzzle.
It begs the question, who actually defines the value of a stock at 4:00 p.m.? Like, are we even trading fundamental companies based on their cash flows and products anymore? Or are we simply navigating the mechanical plumbing of the options market?
Honestly, it's a bit of both. The fundamentals dictate the long-term trajectory, but the plumbing, that dictates the day-to-day survival.
Well said. The headline numbers might look pristine on a day like today, but tomorrow morning, we're going to find out exactly how much liquidity is actually left in the system. Keep your position sizes tight, watch those gamma levels, and we will see you next time on the Deep Dive.